All right, everybody, welcome back to another episode of the Indy Investor Pod. This is Indy Investors talking Indy investing, and we just like to bring everyone on here that is doing something around Indianapolis regarding real estate investing, drop some knowledge, bring value. And today I'm really excited for today's guest. We've got Quentin McNew out of Illinois. He's going to share what's been working for him and a little bit of his tips and tricks to help everyone out there. So with that, let's get on with today's episode. All right, guys, what's up? Welcome to today's show of the Indy Investor Pod. I've got Quentin McNew, man. How you doing?
Awesome. Glad to be here.
Yeah, man. Excited to have you on today, especially having a fellow Midwestern guy out here. So you're hailing out of Illinois, always repping the Illinois. So
Orange and blue.
Yeah, just our neighbor to us here in Indy. So yeah, like I said, really glad to have you on. I've been following you for a little over a year now, and I know that, you're a young guy, relative to most people doing this, real estate investing and building a portfolio, but just really impressed with what you've been able to accomplish so far. And I know you're going to keep doing more, but just excited to hear about your journey today and, kind of dive into what's been working. So, before we get started, how about you just tell us a little bit how you got started into real estate, and then kind of when you decided to start investing in Indianapolis specifically?
Yeah. So when I got started in real estate, it was basically just a couple books. The Rich Dad Poor Dad, that book's created more millionaires than anything.
Right.
Then when I was doing my bachelor's and master's here at the U of I actually validated a country club. And I've never been in that environment. Mom's a hairstylist, dad's a carpenter. But I'd be there, I'm like, man, these guys got a lot of time. I was like, whatever, driving nice cars. So kind of being in that environment kind of changed me. And then when I wasn't parking cars, I was reading. It was usually, 2 to 4 hours right there. And doing charter bus driving on the side for $20 an hour. So I drove a charter bus to Chicago, St. Louis and stuff. And that was 10, 12 hour shifts of straight content in one ear. And there was other, without charter bus was after college, but after my master's, I was driving charter bus because for the knowledge component, I had higher paying jobs like $70K on a couple of logistics, but the knowledge and wanted to get into real estate. But I got into real estate when I was going to my master's Valley Country Club. Across the street, a house, a 3-bedroom, 3-bath house, 2,000 square foot ranch. And I'm like, price per square foot's there. The low price per square foot's there. Yeah. Like my favorite thing, looking for a deal, it's there. So I looked in there, bought it, framed a 4th bedroom, made it 4-bed, 3-bath. And since there was 3 baths, we wouldn't have too many fights on who spaced the 2. But it was an animal house. It was a zoo.
Right.
So I had each bedroom for $450 a month. And then the 3rd bedroom, I Airbnb'd it. So I kind of hybrided in the house hacked everybody. And it brought in like $1,500 to $1,700 depending on Airbnb. And my payment was $900. I'm like, holy cow, I was like, I don't got to make that much when you knock out your biggest expense.
Yeah.
Because Americans' biggest expense, usually 30 to 50% of everybody's income is either to rent or a mortgage. And so when you knock that out, I'm like, wow, I can start doing this again. So then I put my first 20% down on my first property I was looking. I'm like, where do you find property? Oh, the MLS. So I just looked on market, my first one, $32,000 was the cheapest house in Champaign County where I live. And it ran for $640. Section 8, so 2% rule, just a base hit. It wasn't going to be appreciation play and stuff, but I knew cash flow. It's hard, you can't get knocked out cash. So start there, build up some base hits, start building up the balance sheet and collateral for the home runs later. That's kind of how I got started. When I put that 20% down on my second house to invest property, it's like, I got to save up a lot of money to do this again. This isn't scalable, putting 20% down on each property unless I have a lot of money or know somebody with a lot of money. So that's when I got into No Money Down, Robert Allen and Carlton Sheets. I read those two. I'm like, I don't have any money. What do? I go read a book about what do I do? I don't have money. And so I started doing those creative strategies. And that led me, No Money Down, private money, hard money, 0% credit cards, leveraging anything of value as collateral. So I did my car, I put a lien on my car for a $3,000 loan to use for investing, just anything of value. I was doing probably more crazier than I needed to. But when I didn't have the money, it just made me be resourceful with it, anything. But yeah, those two books, it was only a hustle problem after that, because
Right.
those two books get you thinking of all this stuff you never thought about.
And how old were you then when you got started? Like when all that went down?
Yeah, so I finished my master's 25, so 3 years ago. I'm 28 now.
Okay.
And I was 25, didn't have anything. My goal starting out, when I bought that first one, I locked in a 30-year fixed. I said, I'm going to buy it a house a year, lock in a 30-year fixed. I don't care if the market goes up or down. I got a fixed in payment. I got certainty.
Mm-hmm.
And then next year, I'm going to buy another one, 30-year fixed. At age 30, I'll have 5 houses, 30-year fixed, and I'll start paying them down. That was my plan going into it.
Sure.
At 25. And then I saw it. I'm like, oh, this is powerful. And then you hit that first Burr deal. You're like, holy cow, it's $60,000 of equity created in 2 months.
Mm-hmm.
Then that belief changes, like, this is real.
Yeah.
You read about it, but I don't think you really get that till that first one.
It hits you. Yep.
A couple guys that I call it the Roger Bannister moment. Nobody can get the 4-minute mile, and the Roger Bannister does it. And then like a month later, you have 3 other
Someone
guys
else does it. Yep.
Yeah. So, and that's why I'm huge on masterminds and stuff. And yes, seeing you and Brian in person finally. Right. On those events, I'm big on that, because you're next to people and your belief systems change, because you can hear all these experiences. So I'm huge on networking and leveraging people's experiences.
Yeah, I'm the same way, man. Is surrounding yourself with people doing bigger things is the best way to learn, and it helps me out so much, man.
I take pride in it.
Exactly. So that's awesome. That's a cool way how you got started. So fast forward to when you started doing stuff here in Indianapolis. I guess what kind of had that first deal go? What drew you to the city? Kind of talk about that.
Yeah, I did like a macroeconomics study. Real estate radar guy is one of my favorites, and I study real estate, but I also study like finance and economics and stuff. And Indianapolis distribution hub, billion surplus state. Illinois is terrible on property tax and stuff. I love Champaign though. It's like I was at an investing thing here in town, the RIA meetings, which I recommend everybody go to, your local RIA meetings, and great place to find private lenders too. But you go to that, and somebody like, yeah, Champaign's the fastest growing city in Illinois. Somebody raised their hand. They're like, isn't Champaign the only growing city in Illinois? To the university. So it wasn't saying that. But I knew that, and I knew I didn't want to be tied to one geography, one like economic drivers, obviously university here. So I actually looked in Florida, because warm weather, lower property taxes, and Tennessee. So I have one in Memphis, and I started looking there, and I was looking at Nashville, but Nashville was crazy prices. Yeah. So Indianapolis, though, the rent to price ratios just made sense. Good property taxes, landlord friendly, and it was 2 hours away, which I didn't want to be too close to it, because then I'd probably try to micromanage too much. So forced me to get systems in place. But for Illinois, just a terrible kind of bad state. But yeah, Indianapolis having all those macroeconomics going, distribution hub. I've always liked it, blue collar. You actually travel and get around, unlike Chicago up there, you're staying in. I just love Indy for those things. And then being 2 hours away, I have friends in Indy. It's my favorite market in the nation, but it goes back to probably the main thing that wasn't as crazy to me here as it would be to guys in California, which at the event, I was like, everybody's from California. And I met one guy from Utah, but everybody else is from California. And I told him, like, I would be too. I mean, the rent to price ratios in Indianapolis are crazy. Mm-hmm. And they're crazy for me, or they're still good for me too, being in the Midwest, because a lot of people use the equity and appreciation goes from those volatile markets, invest in the Midwest or Southeast. I say the Big Ten or SEC.
Right.
But yeah, the rent to price ratios are great in Indianapolis. And then the teams on the ground and the operators, once I started like property managers, all the people in the Facebook groups and stuff, I'm like, okay, this is the people network. Everything's just kind of was there in place.
Yeah, we definitely have, if anyone's out there listening and is actively investing in Indy, we definitely have a good community of network going right now. And it's really taken off over the past couple of years. So you could probably see like everyone kind of connecting with the same people over time, and everyone kind of knows who's doing what around town. And I love it that way. So so up to today, what's kind of your real estate investing stat card, your baseball card? If we turn it over, how many homes have we flipped? What's our portfolio up to? What's that kind of look like for you?
Yeah, I flipped a couple just because the rent price ratios weren't there and wholesaled. But yeah, I'm pretty much all buy and hold investor with about 70 properties total, 93 units the last 3 years. And there's one retail, about 10,500 retail strip mall.
Okay.
But of the 70 units, about 59 of them are single family houses, though. It would have been a heck of a lot easier to buy a 70 unit apartment complex.
Right.
I'm in a couple of masterminds, like Tim Broad's 4,200 units. And I never really looked at it, just go for the unit count. It's kind of irrelevant. I want net income, how much money is in the deal and stuff. But now I'm looking for more and maybe taking a lower yield just to have more income to fund roof. Because I'm starting to find that CapEx can build up when you have 59 single families. But those are mostly here in Champaign. I have one 8-unit building on the outside of Indianapolis, though. But
Awesome. Yeah. And that's just, I think it's really impressive what you've been able to do over the last few years. Now are you investing? I know you kind of do a couple, like you're a licensed broker, right?
yep,
Also in the military. So like how much time do you put towards your just real estate investing a week or a month or like how's it split with whatever, all the stuff you're doing on the side?
yeah, so I was doing my master's, like I said, did Valley Country Club, charter bus, IDOT, 7 to 3:30. Military is only 2 days a month.
Okay.
And then when I bought that first one, I got my real estate license. So there's 5 little jobs. So you really can't, like charter bus is only 2 days a week. So yeah, it was kind of a crazy schedule. When I got to about 20 rentals, and I was self-managing everything until I got about 40 rentals. I'm like,
You're brave.
Like, oh yeah. I was like, and then I read Jocko Willink, Extreme Ownership, and I said,
Yeah.
I can't be a property manager anymore. I can't babysit and nobody takes, it's just, that's what property management is. But I was like, all right, I got 40. And I was like, you can be profitable self-managing, you can be profitable outsourcing it. You just can't scale outsourcing it. So I kind of made a decision and I was like, it brings down my energy property management. So I finally, around 40, outsourced property management. But I was doing all those jobs till I had about 20 rentals. When I hit 20 rentals, and I went on to the real estate guy summit at Sea Trip, and I was the brokest guy on the shift. We were talking about the environment. It was April 2018, so a couple years ago. Robert Kiyosaki's on it. I'm like, oh, he's like Michael Jordan. It's like Michael was 6 days. So that was like, it was like minimum takes like 5,000. I mean, it's crazy, and that was a lot because I only went to like 3 events before this thing. I got told about like, oh, if you're 25 or under, they have a young adult program, well, where they have a fund and they'll give a discount to 25 or younger. So I was like, oh man, I'm 25. I'm like, they're doing that urgency sales on me though. That's why they told me that. So I'm like, no, I was like, let's do it. I was like, well, I'd be better or worse off 5 years from now. I've only been free events, but I did it because I'm like the caliber of people that are there, because the price ticket, I'm paying for the people not there.
Right.
So,
Right.
the package, you're not getting, oh, I'm interested in that. You get like guys committed in it. I'm like, let's go, let's do it. I went on that trip and I just stopped looking, W-2 jobs and everything, being around Kiyosaki and those guys for 7 days. And then when I got to about 20 rentals after that event, that's when I went all out on real estate with just my real estate license now. And then military is 2 days a month. But the great thing about the military is the network and a lot of transferable concepts with standard operating procedures and systems. I'm probably more occasion I should be on that stuff, but
yeah, that's awesome, man. That was a life-changing trip, I bet.
yeah, I was the brokest guy on that ship. I still believe it.
Yeah, that's what you want to. That's where you want to be, though. Like you want to be the dumbest person in the room and the brokest person on the ship. You're going to gain the most knowledge out of that.
Yeah.
So you kind of mentioned something earlier. I want to circle back to it because I think it's important for anyone that's kind of, I'd say under 30, maybe under even 25, listening to this and really wanting to jump in. You mentioned that you got pretty creative on your financing early on. You had, using hard money, private money, using some credit cards. Kind of talk more about that kind of each strategy that you kind of got creative with and like the right way that helped you go about it. that could, so if someone wanted to use like a 0% credit card, like how do you go about that to get started out in real estate the right way versus the wrong way, or share
I've done
anything
them
that,
all. Done them
yeah,
both wrong
yeah.
way. I did the wrong way. That's like I ran into a problem, solved the problem myself, and now I help people with it. You know, that's kind of the normal transgression there. But starting out, yeah, 0% interest credit cards. I'm like, oh, I can get 0%. I know I can make 33% cash on cash returns on 2% rules. The one I just did, just being on the spreadsheet guy.
Mm-hmm.
And so I got that first one, but I'm like, oh, the debt I put on these personal credit cards, it's raising my utilization, so drop my credit score. And you want to maintain our 30% utilization personal. Then I had my LLC I created, put properties in. I got a business credit card. I put debt on it. It didn't show my personal. I'm like, wait, what? This is crazy. So then that opened the floodgates to me going crazy over here. I'm like, oh my gosh, all this debt over here, it's not affecting. So I did the first couple. They will look at your personal credit to approve you for the business credit card. So they're going to do a hard inquiry on your personal credit score, look at your credit score. And if you have over 740, you'll get approved for a $20,000 chasing card. But after you get that business credit card, the debt on that business credit card does not show up on your personal. So
Okay.
that was huge. And I had that 0% funds. Now I'm like, okay, how do I get the cash off these funds? So 3 years ago, I was actually going to drug seized auction. I was going to buy something tangible that I knew the value in, kind of like wholesale. You can run comps, know the value, minimum trade, and what you're going to get. I was going to drug seized auctions. I'm like, I'll just buy a car with a credit card, which I bought a Honda Civic for like $2,900. I bid on a couple other cars, but got that one, and I had to offer $6,000 next day. I'm like, oh, this worked. And then I'm like, wait, before I sold the guy, it's like, I actually ended up keeping that car. 95,000 miles. So I ended up keeping that. But that was one of the things I was going to do, which would work. But then what I ended up doing was I'd buy $10,000 of gold, because gold's not volatile like Bitcoin. It was just
Right.
kind of stable. So I bought gold. There's transaction costs there. Bought the gold, sold the gold to get the cash. And that's how I got the cash. So I buy $10,000 of gold with the credit card, sell the gold right away. You pay some fee there. And I had that cash use down payment. But now you can just screw everything I just said there. And Plastique, Plastiq, is a company that came out last year, and they charge a 2.5% fee to do it. They will wire funds from your credit card to closing. So now, and it's short-term money, it's only 12% interest. So you only want to use these funds, I tell people, for flips, burrs. Burr's the greatest model ever. Was right. Got the deal. I say it doesn't make sense to put short-term 0% money on a down payment on a 30-year holding. So I call the title company, say, hey, send me the wiring instructions. Get the wiring instructions. I log into Plastic. When I get into Plastic, I enter my credit card information. And then next page, like wiring instructions, the title company, enter, and I have a card, 30,000, 20,000 gets sent, and they take their 2% fee. But now that company sends the funds from your credit card to closing, and it's 0% funds. And then after 3 months, say I'm all in for 70,000. After 3 months, go to my local lender, say, hey, just give me an appraisal. It's worth 100. They'll give me 75, pay off everything. I have no money in the deal. So that's how I was doing it with credit cards. So it worked great. And then
dude, that's great, man.
Yeah. So that's a good strategy there. And then the other one is private and hard money, which if I had private money, I had a couple guys that would do it, and local RIA meetings and stuff could lend you on like here in Champaign, I get private money, lend on everything. For whatever reason, Indianapolis, my private money guys didn't want to go to a different state. I was like, okay, whatever. So Indianapolis, I use hard money for the 80%. And then instead of using a private money for everything like I do here, Indianapolis, I use hard money for the 80% purchase usually. And then I raise 20% of private money for the purchase, or 20% from a credit line or 0% interest credit card here. Okay. So I'm 100% financed, but I don't say I'm 100% leveraged, because my cost basis, it always goes down to cost basis. I was like, if the property was worth 100,000 and I had $80,000 hard money and a $20,000 private money or credit line, I'm like, that's stupid. Yeah. But if I have a $60,000 bank loan, $20,000 private money here, but they're protected because it's worth 100, there's a cost base, there's equity cushion there. So that's why I don't, not too public about credit and stuff on social media, all the strategies, because it's a tool. It can be bad and good.
Yeah.
But that's kind of the strategy I scale in Indianapolis: hard money, private money, or hard money, and credit lines or credit cards. But here, so those kind of structures on leveraging. But here, most of the stuff, the other two methods are just a land contracts where go to an owner. I go into everything I need. I just need price or terms. It's like I can give you, wholesale and give them a price or terms, but I just need to control one of them. Like, yeah, I'll give you 120,000 for your $100,000 house, but I'm going to pay it off in 40 years. But the price, if I get them like, oh, I'll give you 100,000, no money down, we'll amortize over 20 years, do that. And so that's just doing a land contract where it's held in escrow.
Yeah.
But the thing that really helped was I got a couple local lenders and some lenders won't allow this for the seller to carry back that 20%. And that's when it really was huge here. I haven't found this lender in Indianapolis because after 2008, they kind of stopped doing it, allowing a second carryback on some. But yeah, some of the deals, like the triple net lease deal is $1 million asset. The bank loan gave me an 80% loan. The seller gave me the 20% carryback.
Okay.
I got a check at closing for $35,000. That was because tax credits though, so I didn't go spend that. But it was $1 million asset. 80% bank loan, seller carry back 20%. And my payments after everything, taxes, insurance, everything is $10,000. The gross income is $13,000. So there's $3,000 cash flow there. And the great thing about triple net is the expense ratio is only like 10%. Residential, it's like 50%. You 50% rule. So triple net's great because they pay for all the maintenance and stuff. So I'm actually, right, when the income comes in, I'm actually keeping it. Because residential, it's not if something breaks, it's when.
Yeah.
So the expense ratio is a little higher there. But that seller carryback was huge because some sellers, they on that building, he might have only owed like 300,000. So he's getting 800,000 at closing. He's got 500, and that carryback, he's only gonna be paid on what he receives in there. So it's a huge education process. Mm-hmm. And so it's more educating on the seller finance because some of these guys are old, they just don't know. So I'm like, yeah, on a couple, I'm like, oh, I could cash you out this year, but like seller had 5 properties. I said, how about this? Year 3, we cash out this property. Year 4, we cash out this property. Now you're really spreading out. Instead of you taking all 5 properties cash out this year, because he's owned them for over 25 years, his basis is almost, he's going to get killed.
Right.
He's like, oh my gosh. He's like, is that? I was like, yeah, it's real. Talk to your CPA. I tell him to talk to your CPA. He's trying to be,
Yeah.
But that seller carry on that deal is huge because no money in the deal, 100% leverage, and with cost segregation, $1 million asset, you can get a $200,000 to $300,000 tax write-off year 1. No money in the deal. And with active real estate professional, you can write that off against your active income, the losses. So, but yeah, the seller carryback is huge if you can find a local lender. And really, it should come back down to cost basis because they think you're over leveraged. But if a seller, if the bank gave you 600,000, seller carry back 200,000, it's worth 100. The lender should still be fine there because there's it's a good cost basis. So, yeah,
man, that's awesome. I think we all need to go back and re-listen to what you just said because you're just dropping bomb after bomb, man. That was good stuff. Anyone could take something away from that. So let's kind of shift to when you're taking down properties. What's your systems and procedures look like for rehabs? And I know just from following you on Facebook, you're a very analytical person. You're always posting, you're always on that blackboard, man, just going nuts.
I gotta see it.
Yeah. So kind of break it down for me. Like, what are you looking for when you're, looking over your rehabs and what your systems look like for that?
Yeah. So a lot of them just getting around, like people around the country going to events, looking at certain things, how it looked. But I used to have, when I first started, I did everything wrong. I was doing my own work. That was terrible. But one house would be this color, one house would be that color. But now I do French gray walls, white trim, vinyl plank down to the SKU at Home Depot.
Okay.
Standardize the whole rehab process. You gotta get a drink. Sorry.
No, you're fine. Yeah, I think a lot of people, they have like their SKUs down, and so whenever they buy a house, like, this is it, just give it to their contractor, and they just go to town.
And then stainless steel. So I told a couple of my friends, like, is that the same, a different house? I'm like, yeah, but if you've been in one, you've been in them all though.
Right.
It's the same finishes, and it frees up your mental bandwidth for something else. So I just standardized that process, found a rehab crew, and now I can look at a rehab and price it out quick. On my vinyl plank materials, it's $2 a square foot, $1 to lay, so it's $3 a square foot. And I no carpets in any of my properties, so it's all vinyl plank, called hardening the property. So I see $1,000 or 1,000 square foot home, I'm like that's 3,000 floor rehab.
Okay.
And price per square foot on paint, $1.50. So I can just do quick kind of rehab projections there and work backward from the comps. But yeah, standardizing the rehab process is huge. Because like, so when I started out, I had all these different things and I'm like, oh crap, I forgot it was there. But now it's like, nope, Whirlpool appliance package, stainless steel, certain vinyl plank floor, usually $1.50 to $2. So yeah, staring down the process was huge.
Yeah, that for sure. So when so do you just kind of run those quick numbers then? Because you know how much, your material is going to be, or how much material and labor is going to be based on your, your system. So when you're looking at a deal, you just start there, you say, hey, this is what it's going to be. Now you just got to make sure that it aligns with your purchase price and, what the after repair value is going to be.
Yeah. So I look at it, see if it's cosmetic upgrade. I can say for total house, just paint, carbon stuff. I'll say $10 to $15 a square foot.
Okay.
I look at the comps. You can do times 0.8 or 0.7 minus the repairs. So 1,000 square foot house, I say, okay, $50 square foot, it's going to be 15,000 on that. So kind of price per square foot was huge. The book on estimated rehab costs by Jay Scott really helped me kind of having a price per square foot and having a fixed cost and everything. Because I started out, I was doing Craigslist, paying a couple of friends $12 an hour to paint rooms and stuff.
Right.
Too many variables. So it's
yeah.
just like, I am stupid. Let's get this system like fixed where it's just numbers and thinking on it.
Yeah, it probably helps you move quicker too. When you see a good deal come through, you got to analyze it quick right now because everyone's going after it. So, so last question here: how are you sourcing for here in Indianapolis? How are you sourcing your deals? Are you working with an agent? Do you do some wholesale? Work with some wholesalers, or what's that look like for you?
All the above, but
okay.
A couple of realtors, property manager. Reach out to property manager if they see any value adds. Don't really get much there. And then wholesaling, I'm on some wholesalers lists just to get market data and look, see if something's there. I try to stay 1970 or newer properties though. I think it's because the older properties punch me in the face too much for repairs and maintenance. But wholesalers, and then direct mail, cold calling. I don't do cold calling or direct mail in Indy because I know you guys are there. But you guys are there in and out, and having that as a huge competitive advantage. And I just like my hyper focus here in Champaign. So, those are the main things. But the mainstay, man, just bought a couple off the on your mailing list, of course.
Yeah. So basically, you're just trying to be in front of as many deals as possible. So you're just trying to get them all sent to you from all different directions.
Ideally, yes. That's why I go to the sheriff courthouses, because my marketing expense is zero when I go there.
Right.
I love that type of stuff. My wholesalers, I am fine to pay. I don't even care what they make. I think a wholesaler made $50,000 on me one time. But I don't care because I just you factor it in. But like I always say that the three highest leverage activities for real estate investor is finding deals, finding money, and then optimizing your operations, like property management. So my day now with the right people and teams in place is analyzing usually 15 to 20 deals a day. That's what I do.
Okay. Awesome, man. So we're kind of towards the end of the show here. I think everything you set up to this point has been gold, man. So I really appreciate you kind of sharing what's worked for you. Last thing, man, just, what's your favorite thing about Indianapolis outside of real estate? What's your favorite thing about the city?
I'm a big quarterback guy. So I always love Peyton Manning, Marvin Harrison tearing it up.
Okay.
But I just like the affordability there. I was going to say, I was just there. I'm like, I don't know anything that stands out too much there now, but yeah, I like it. Just the blue collar feel. So
Yeah, no, for sure. And then lastly, if anyone wants to connect with you on social media, where can they find you?
Yeah, my Instagram is Q McNew 23. You shoot me a message on Instagram, and I'll usually respond within 24 hours. I kind of time block everything now.
For sure. Well, again, man, I appreciate you coming on. Lots of good knowledge. It's going to help out a lot of people out there. So I really appreciate it. And with that, this is the end of the show. This is Indy Investors talking Indy investing, and we'll see you on the next show. Thanks.